Hi students, welcome back again. We are discussing in this series of lectures about the break-even point, the CVP analysis. So just a brief review for that. The break-even point is a point where the company is in a no profit, no loss situation. So in the previous lecture, we have discussed how it is calculated, the break-even point, number of units, how it is calculated. So the same example we will continue, but we will add some of the other things with that. So we just assume the three basic values, and obviously these values we will continue in the next lectures also. And the sale price per unit of that product, they have one product and they are selling it for 15 units, $15 per unit. And the variable cost for that product is how much? That is the $10. Now what is the variable cost? So it may be a material cost, it may be a labor cost, it may be including some of the factory overhead, which are the variable indirect materials, indirect labor, or any other cost which is direct or indirect related to the variability. So all the costs are included, and they have a calculated one that $10 per unit is the variable cost. If they're manufacturing and selling one unit, their cost for one unit, the variable cost portion is $10. And then they have a fixed cost that is obviously per period. They have paying almost $5,000. This is for what? It may be for the rent, it may be for the salaries, it may be for the some of the fixed expenses like a depreciation. So whatsoever is the total cost for that specific period, that is $5,000. Now $15 they are selling, $10 they are a variable cost occurring. So here we need to know that what is their contribution margin. So before understanding the contribution margin, you have to understand the very basic thing that is called basically the marginal cost. If you understand the concept of the marginal cost, so automatically you will understand the concept of the contribution margin. See, we take a simple example. The variable cost per unit, like a direct material, direct labor, other thing like a fuel, other expenses which are the manufacturing other, so it is $10. So if they are producing 0 unit, 1 unit, 2 unit, we are just assuming that the number of units here, or let's say 100. If they are producing 0 unit, means if there is no production, the variable cost will be obviously 0. If they are producing 1 unit, it is how much? It will be 10. If it is producing 20 units, it will be 200. They have like a 0 units production, the variable cost per unit is $10. So the total variable cost will be how much? That is 0, because they are not producing anything. It is variable, it is changing with the activity. But if they are producing only 1 unit, it is $10. If they are producing 2 units, it is $20. If they are producing 100 units, it will be 1,000, and if they are producing 101 unit, it is $1,010. So in a simple way, if they are increasing 1 unit, if they are producing and selling 1 more unit, what is the change in the cost? So that is how much? That is the $10. So this is what, this is the marginal cost. So the contribution margin is what, that by every new unit of the sale, means if they are selling 1,000 units and then now started 1,001 units selling. So with respect of that, what is the change in their margin with respect to the contribution? How much that is contributing to the profit? So it is a simple formula that we have, that is the sale price per unit minus the variable cost per unit. So 15 minus 10, so the answer will be $5. So this is the contribution margin, means if they are selling 1 more unit, it is contributing in the total profit by $5. Means with every 1 more unit sales, the total profitability of the company will be increasing by $5. So that is the contribution margin. The break-even point we have already calculated, that is in the number of the units, the volume. So the formula was very simple. That was the fixed cost divided by the sale price minus the variable cost. So it is 5,000 as in the question. 15 minus 10, so the answer is 1,000 unit. Means if they are selling 1000 units, the company will be getting no profit, no loss situation. So the company will be in a break-even point. Now, the next thing that we have, sometimes they want to know, obviously they have 1000, but they want to know that what will be the total value of the sales which they want to achieve to get the break-even point. So for that, we have a very simple thing, that is the break-even point in units multiplied by the sale price per unit. So the break-even point we have calculated here, 1000, and the sale price we have here given, that is a $15. So the answer is $15,000. So here it was in the units, here it is in the dollar. Means they sell at the specific price, at the specific variable cost, at the specific fixed cost. Means in the current circumstances, if they sell 1000 units, so they will achieve the break-even point. Or if they sell $15,000, mean the total value of the sale is $15,000, means again they are achieving the break-even point, which is a no profit, no loss situation. So we have things here. First of all, the contribution margin. It is the sale price minus the variable cost per unit. Then we have a break-even point in the number of the units, means as a volume, and then the break-even point in the dollars or in the value. So these are the basic concepts related to the break-even point. So now here we have one more thing that is very important, is the concept of the target profit. As a management accountant, maybe you're owner of the business, or maybe you're a person who is related to the production or any other person who is in charge of the finance or anything. They want to know that, let's say their target is, for example, $20,000. They want to get a profit for the specific period. They want to know that their target profit is $20,000. They want to know that how many units they have to sell. So you have to calculate that one. So target profit units. So the target profit units, it is very simple. So simply write the formula which was related to the break-even point. So that was the fixed cost divided by the sale price minus the variable cost. But just add one more thing, that is the target profit. So we have a fixed cost here, how much? That was 5,000, plus we have a target profit here, that is how much? That is $20,000. They want to achieve that profit, and the sale price obviously is 15 minus the variable cost is 10. So 25,000 divided by 5. So the answer will be 5,000 units. So this is the answer for them, that if they want to get a profit of $20,000, they have to sell how many units? 5,000 units. And if they just want to achieve a no profit, no loss situation, so they have to sell how many units? They have to sell 1,000 units, and the total value, or the total, you can say the dollar amount for that, it will be $15,000. So this is the concept, that we have a contribution margin, the break-even point or the volume, or in the number of the units, and the break-even point in the value. And then the target profit units, means if they want to achieve some specific profit, they are asking that how many units they have to sell at the specific price, at the specific cost. So the answer is that they want to get a profit of $20,000, so they have to sell 5,000 units to achieve that profit. So this is the concept of the break-even point, the cost, volume, profit analysis. So in the next lectures, in the next series, that we will continue the same concept, that the break-even point, how it is calculated for the multiple products, and again with respect to the graphical presentation, if there is a change in the sale price, in the variable cost and the fixed cost, how it is affecting the break-even point. So that we will continue in the next lectures. Thank you very much.